Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today, it's our favorite, the Primary Vision Frac Spread Count. So we're going to go through the spread count, but then we're also going to look at what is happening in Asia, especially with India and what's happening there. And then we're going to touch on the jobs number just because it's relevant for what we're thinking about demand and where demand can go. But we'll talk about that when we get to it and some of the underlying pieces across the jobs number. But without further ado, we're here with +9 spreads, so we're coming in at 221. It's right at kind of the top of the range that we've been thinking. You know, our view was that 212 was probably going to be the low, and then we were going to push closer to 220, and we're going to stay kind of within this range over the next week or two, just because. And one of the things that we see here is, you know, Permian numbers went back up. And as we said last week and the week before, they didn't go down because they were inactive or going back to the yard. They were just going between jobs. And that's where we're coming back through. And the smaller basins have gotten a little bit more activity. And that, again, is going to come down, which is going to keep us within this range. But then as we get into the back of May, that's where we think we're going to start to see this trend higher. And one of the things that we've been talking about is that we're going to kind of follow that 2017 path in terms of the rate of change. Not that we're going to get to that number, but that we're going to see a very similar pattern in terms of just getting a steady move up in June, July, and then for those that work in the field and those that are following our work, you can see that July is kind of where then we go sideways, where July, August, September is where we see the lion's share. And then as we start getting into October and then again into November, we start to see some declines as, you know, we have people going home for holidays, and that's where you start to see some of those adjustments. And then obviously North Dakota gets a little chilly, so some things tend to slow down a bit. And before we go and look at some of the charts, one of the things that we just wanted to highlight is the Colonial Pipeline. So right now they're having network issues, which is stranding barrels of refined products in the U.S. Gulf Coast. So it's impacting what it says about both of the main lines, which is about 2.5 million barrels a day of refined product. So we'll have to consider this, depending on when it clears and how quickly it will clear, that will impact the EIA data just when we're considering about builds within Pad 3 versus Pad 1. But that'll be something to watch. So here, when we look at the 3 months, you can see, again, we're right back to the top, 221, that new little high. But here is where we continue to see kind of that sideways move. And then before we start to see that acceleration that will come into June, July, and August. But the thing that we always keep looking at is rig count, because now rig counts are going to have to start to accelerate in some of the other basins. Now, the Permian rig count and the frac spreads that are running are essentially keeping things flat. So we shouldn't see DUC counts really going up or down at this point, just based on the current rate. But we continue to go through inventory when we start looking at Eagle Ford and Bakken and some of the other basins, which is why we're going to start to see some of that activity. Then when we look at Appalachia and what happens there, typically you get rigs that get picked up. They do work through the summer, and then you start to complete as we go through some of the core demand times and trying to manage that. I apologize, I have a little bit of a cold. So when we look at comparing to last year, obviously we're coming to that point last year where we reached that low. But when we look at 2017, that's where we think that rate of change is going to be very similar as things continue to normalize and grind higher as we go through and peak in the middle to end of July before we start going sideways. Now, just thinking about what's happening in the U.S. and we did a whole report today looking at physical pricing. What does that mean? How is that being adjusted in general? Because we had a big makeup number, if you will, on the export side, but it's going to be struggling to see kind of that next level while all of this refined product continues to come to market and we have a new wave coming into the U.S. So just looking at some new waves coming to the U.S., we're getting a big slug of product, refined product, a really clean product across the board coming from Saudi Arabia. And it's interesting because at least 4 tankers with about 1.7 million barrels of gasoline are coming from Saudi into New York, and they should be landing in May. this just puts into context the amount of barrels that will be coming in and the last time we had something this large coming into the U.S. And it continues to speak to the issues that we're seeing in the demand profiles and just where a lot of this product is going to go. And that's one of the things that we've been saying on the EIA show is that we're good. The U.S. is obviously, we're reopened. You're starting to see that demand. Well, it's still below, I think, what was seasonally expected. We're going to get a little bit of a seasonal bump. And there's just a lot of product. And what do molecules do? They go to the highest bidder, they go on a boat, and then that's where they end up. And that's where we continue to see additional flow coming into the U.S. And now it's not just coming into the U.S. You know, the other side is European imports of oil products from the Middle East, which is mostly the middle distillate side, are set to go up in May, pushing volumes to the highest in 7 months. So this is what we were talking about in the EIA show, where we keep getting this pushback coming from the lack of demand in Asia, increasing exports of refined product in Asia, all getting displaced further down. So 23 tankers hauling about 1.56 million tons of Middle East refined fuels are expected to arrive in Europe this month, being May, including six tankers that have arrived already, which is why we're going to talk about what is happening in storage, just to kind of put that into context. Now, on some of the on a better side of the equation, Total actually just purchased Urals for dated only $1.90 below dated Brent for the end of May, or $1.85 again for $1.85 May 28th to June 1st, which in the last bid was $2.40. So it's getting a little bit better. Again, this is a net positive in terms of kind of some of that physical market that we talk about. But then we have to look at, okay, well, what is the physical market doing in general right now? And we look at Angola. So Angolan June cargoes are moving at a pretty good clip right now, which is a net positive. On the other side, on the Congo side, we have actually 4 cargoes that are unsold out of 7 shipments, which is fairly large for this point in time. And that's going to be something to watch, because a lot of that normally goes into China. And when we think about China and what they're doing in terms of Iranian barrels and some of these cargoes that they're playing against, it's going to become a little bit of a bigger issue, while Nigeria continues to sell, with most of the country's cargoes for June loading yet to find any buyers. And that's going to be the biggest concern when we start talking about India and some of the flows that are coming from the Middle East into the Asian markets, because we've actually seen India pick up their normal cargoes in June from Saudi, which is, and this is after they cut prices by 10 cents. But also remember, Saudi Arabia is increasing volume because they're increasing production in May and June. So even though you could say, well, India is obviously back, they're getting better, but there's also more cargoes that Saudi is trying to push out. And the rumors are that they're coming in a bit below that OSP point. But again, these are things that we're continuing to watch. And then on the Glencore side, Glencore bought Ekofisk for 95 cents plus dated Brent, which again is a stronger price. So there's some bright spots in some of the physical markets, some weak spots, and these are going to be this bifurcation that we keep talking about in grades, and that's why we like to look at all of them to understand where things are going. Now, the China super tankers super tankers heading to China, it's kind of following that seasonal trend, which is what we were expecting. And when we think about what has happened so far, so again, the Arab light crude was set at $1.70 above the Oman Dubai average for Asia, which is down 10 cents, still elevated in general. And India is obviously one of the largest crude importers, importing about 80% of their needs from the Middle East in general. But the one thing that we want to look at is, okay, well, what is happening going forward? So India-bound ships climbed by 7 week over week to 27, which is the highest since September 21st, 2018. And remember, there is a huge purchasing that they did from West Africa, and that's already now en route. The question is going to be what happens once it gets there, because we have refineries that are cutting runs a bit, still elevated, but they don't have a lot of spare capacity on the refined product side or the oil storage side, which is why we keep talking about the growth of floating storage and then the growth of exports, which is why India is starting to churn out extra exports of refined products, which is finding its way into the Atlantic basin. So then when we look at China, speaking of things that are saturated, here you can see that we're pushing back towards the 2021 highs of crude in stock in Shandong, which is a bigger issue, especially when you start looking at, well, what are refinery run rates doing in this region at this current moment? Which is why when we start looking at fuel oil, you can see that they're still at elevated levels. They're still trying to figure out where are they going to move this stuff, or are they going to recrack it, because all refiners have a limit for the amount they can export and import. So once you hit your quota, you have to wait for a new quota, or you have to ask for an extension or wait for the new one to be issued. So this is where they're trying to manage this as the local populace. Again, we're not seeing the same type of travel. And when we look at the Labor Day, which was May 1st to 5th, we actually saw that they traveled 3.2% more than 2019, but it was on much shorter distances. And when we look at the amount of revenue, as we said in the Econ show, they spent 23% less than they did in 2019. And it's driven based on just doing less, trying to do more on a lower cost basis. And you also had sales incentives. So these are things that are weighing in, which was when we look at China's been open the longest, and this is still kind of where we sit on that recovery level. And that's when we turn to, whenever China gets concerned about growth and margin and protecting the state-owned refiners, they come after Shandong. And here you can see, obviously there's maintenance season. I'm not saying there isn't, but you can see where the current run rates are. They're still over the 5-year average, but they're trending lower. And the problem is going to be, because they're getting hit by the government's putting pressure on them. Some of these won't come back after their maintenance season or turnarounds, or if they do, they'll be at a reduced rate to be within compliance and as they go through the different pressure points. Now, when we look at some of the Chinese data sets, you can see the Caxton PMI composite was at 54.7, a growth level. PMI services came in at 56.3 versus 54.2. The problem is it's breaking with what we're seeing on the ground in terms of boats, what we're seeing in terms of movements. And then the PMI official number coming from China is a bit closer to what we're seeing, but maybe there's more movement on the service side, which is something we are seeing. So on the manufacturing side is where some of those slowdowns, but the services side is getting better. So this is speaking to that. So that makes a bit more sense. And if you think about what the CCP is trying to do, this actually fits well into their narrative. Now, when we look at exports, imports were up 22.2% versus the survey of 12.5, but imports started to come down a bit versus estimates at 32.2 versus 33.6. The biggest issue right now is this inherent slowdown that we're seeing as countries are shifting away or adjusting their supply chains. Not that they're stopping from China, because they're not. It's just a matter of utilizing some of the other regions to help diversify and make up some of this difference. These are going to be some of the things that we're going to see in general that we keep wanting to look at, because we see imports slowing a bit. And then once this export goes past and we start kind of getting into this normalized world, where we think that this is going to continue to be some of that pressure. Now, only 15 to 16% of GDP for China is driven off of exports. So we want to watch imports and local demand, which is why that services number is going to be one to watch to see how they're doing in general. But when we turn to Singapore storage, you can see that there was a big jump from 49.9 to 52.6, pushing back to or near the seasonally adjusted all-time high, and the high reached in 2021. And it was really driven based on the residual and middle distillate, as light distillate fell again, leading to, which speaks more to just the amount of exports that we're continuing to see coming from that region, which is why I think that's going to continue to offset, where we think the light distillate will start to build as some of these exports accelerate from both China and India. Then when we look at what's happening in Europe, you can see Europe had some small draws across the board except for gasoline. Now, the reason why this is going to be interesting is because they're seeing some small draws, but there's a big, essentially, flood of new product coming from the Middle East, coming from Asia, heading into the European markets, the U.S. markets, and just the Atlantic basin in general, which is why we think that this is going to continue to trend higher. And if you look at just the gasoline numbers, you can see that there's typically a seasonal drawdown. When we look at this, what is that, a 15-year chart, 13-year chart, you can see that we typically see draws coming out of the gasoline market in Europe, and we're just not seeing that, even though we are getting an increase in exports. Again, 8-week low, but still elevated versus the previous few years. Which is why, right now when we look at demand centers there, demand centers here, we're going to continue to attract some of this flow. Now, when we look at the U.S. numbers, one of the things that we've been highlighting aggressively has been jobs. And we've been saying that jobs are going to continue to disappoint. It's going to be a much bigger issue. And here you can see that non-farm payrolls came in at 266,000 versus the estimate of 1 million. Now, that is obviously a very negative number. It's a problem and something that we've been calling for, because we had this big surge last month when you had a lot of things reopening. Again, the reopening trade, when you look at just jobs in general, you can see the reopening really kicked off in April, where you had a big surge of restaurant hiring, bars, hospitality. And now we're just kind of going sideways. That is the negative side. On the positive side, when we look at average hourly earnings, you can see that they're up 0.7% versus the 0% expected. And then when you look at the average hourly earnings year over year, you can see that they're starting to go up. This is a positive because people are getting paid a bit more, but it's also leading to that inflation story where people are getting paid more, so you have to charge more. And this is where we're seeing some of that friction. Now, the people looking for jobs increased, which is why the unemployment rate did go up, because you had more people actively in the market, again, looking for those jobs based on the labor participation point, which was from 61.6 to 61.7. So these are things that we're continuing to see, but the underemployment rate still remains elevated. We still have a lot of people that are unemployed, as we continue to talk about, almost 17 million on different types of benefits, which remains the overhang, because when do they go back? Is it when we cut some of the benefits, we start to see some of this flow through? These again are giving us pause when we think about the great reopening. And the other side is inflation. So this is just looking at U.S. break-even inflation across the back end of the curve. As we've been saying, inflation is here. It's real. You're seeing it in bonds. We still think that bond steepener is there, where you just want to be short bonds in terms of price, but long yield and rates, because you're just going to continue to see that drift higher. And this is where we continue to see the friction point, and especially when you start looking at retail prices. So when we look at seafood, diet and nutrition, prepared foods, all of these rates are just on a year-over-year basis, month-over-month basis. They're all going higher. We have corn at $7.30. We have beans at $15.08, almost 9 cents. Again, this is where the pressure continues to mount, and it's being pushed through. And this is what we like to look at when we're talking about job deficits. So you have inflation going up, you have expectations of inflation continuing to go up, you have companies that are seeing it, trying to pass through prices, and we're still above the Great Recession after dumping $15 trillion into the market. To be fair, so far at 12.5, but there's more behind it, and this is the issue. So we've dumped in all of trillions of dollars, and this is what we've achieved. And that's why when maybe it's too much and people are disincentivized to work, and you're starting to see these friction points, but this just puts it into comparison as to where we are. And for those that have been listening to us, we've been saying that we get this strong bounce off the bottom, and then the rate of change just drops off, and then it's a really slow grind back higher. That's where when we look at this a little bit differently on the month-over-month change, and this is what we're talking about with, you had this nice check mark coming back up, and then you're just going sideways with that big miss in terms of just the notable. Now, the other side is last month was revised down to 770,000 versus 916. So not only did we get a big miss this week, but we also had a big revision lower the previous month. So again, these are the friction points that we continue to see. And then when we talk about that reopening side, we did a thread on Twitter about it. We talk about it in the EIA show. But when we look at working from home, so working from home dropped in April, and it's going to continue to drop in May. And this is what we continue to point to, where you can see the steady drop. We've seen these people get pulled back into the market. We still think flexible schedules is there. We're seeing the investment, as we talked about in the economy show, where more companies are investing in infrastructure. And companies want it, people want it, but it's a flexible level. So the full work from home is starting to change. Now, one of the funny things that we saw coming back from visiting a friend in Westchester, we actually saw a big billboard of why New Yorkers should go to Ohio to work from home from Ohio based on cost of living, more space, more. And it was just funny to see, because the question is going to be, are we going to see more of that? Are we going to see work from home centers where you can go there and work from home and your cost of living changes in the best way possible? But this is where we continue to see kind of this reopening, which is why we keep talking about it. We're in it. It's happening right now. This isn't 4 weeks from now, 6 weeks from now, 2 months from now. It's happening right now. And that's why when we look at, can you go to a restaurant, a bar, a gym, a shop, go to an airplane, airport, a city, the answer is yes. And this is why when we start looking at, well, how are we progressing? That's where some of that friction comes in. Now, just rounding it out, when you look at the average hourly workers, the average hourly earnings of production and non-supervisory employees, you can see went to a recent high based on the average hourly earnings for leisure and hospitality. So this is some of those net positives in terms of driving some of those numbers higher. But again, that's going to, if you're at a restaurant, look at the food that you're buying, the cost of getting people back to work in the, wash dishes, be cooks, waiters, waitresses. This is that friction point that we continue to see that leads us to, again, be relatively concerned about what are people going to do? How are they going to spend when you're seeing their costs just continue to inflate? And for some, wages are going up. For some, they're stagnant. I mean, we have gasoline prices already pushing back up to $3. And again, just basic food staples continue to go higher, and bonds were not fooled by the jobs number, if you will, because the view was, oh well, inflation's going to go down. It's like, well, let's look at this, and that's why we like to do these deeper dives, which we'll do in a greater level come the economy show next week. So hopefully this was helpful. Love the back and forth. We've had some great conversations on comments on LinkedIn as well as on Twitter. So if you have any questions, love to hear from you. And if not, have a great weekend. Hopefully this is helpful in terms of just understanding the world at large. And again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.